And now, a conversation on the state of the global economy. Please give a warm welcome to co-founder and co-chairman of the Carlyle Group, David Rubenstein, and Semafor business and finance editor, Liz Hoffman.
Well, thanks to David for joining us. David is the chairman of the Carlyle Group, which invests about $400 billion around the world. He's also the owner of 11 copies of the Declaration of Independence, the only copy of the Magna Carta in private hands, and a stake in Semafor. So we're thrilled you could join us. I want to start with high level. We're 3 years out, from the start of the pandemic. Developed countries, developed economies are all back to where they were in 2019. That is not true, by and large, of the developing world and Africa. What's your view on where we go from here, from global inequality, and from really some of the trends that were in train before the pandemic through everything?
As a general rule of thumb, most humans like to take care of themselves first. And so in the developed markets, when they had the problems of COVID, they generally took care of themselves first. Make sure the vaccines were there first, make sure their people had healthcare supplies, and they didn't pay as much attention as maybe they should have to some of the emerging markets. So the emerging markets got less good healthcare treatment. They didn't have access to vaccines quite as quickly or as nice as we did in the developed markets. So, and their economies also had a lot of money being pulled out of the emerging markets as a result of people being worried about where the economies were going during COVID. So less money was invested in some of the emerging markets. And so as a general rule of thumb, as we come out of the COVID period of time, the developed markets are in better shape than the emerging markets, but the developed markets are not in perfect shape. There are many people that think we'll go into a recession in the United States. Some people think Europe is in a recession now. Obviously, China has got some economic problems as well. So nobody's in perfect shape right now. I think the emerging markets have some bigger challenges. And one of the biggest challenges, which isn't commented upon as much, is that the dollar has strengthened so much that it has really made less strong and less effective the currencies in many of the emerging markets. So if you borrow money in dollars, and you have to, in effect, earn your money back in your local currency, you've been hurt a lot. And the dollar, while it's weakened a little bit lately, is still very, very strong compared to where it was 2 or 3 years ago. And as we continue to increase interest rates, the dollar will probably strengthen a bit more, hurting the emerging markets a bit.
So you mentioned interest rates. I think we'll hear from the Fed later this week. I think the expectation is 50 basis points.
Yeah, it's an interesting phenomenon. I worked in the White House for President Carter. And in those days, initially, Bill Miller was the chairman of the Fed. Then he was replaced by Paul Volcker. If you remember back to those days, and it looks like most people are not old enough to remember back to those days, but in those days, the Fed didn't tell you what it was going to do before it did it, and it didn't explain what it did after it did it. And that was thought to be, the way the Fed operated. Under Ben Bernanke, we went to a policy of explaining what they were going to do or what they did more or less after they did, to have press conferences, which they didn't have in the era of Paul Volcker, press conferences explaining what they did. Paul Volcker once increased interest rates 200 basis points over a weekend and never really went ahead and explained it and didn't tell you in advance they were likely to do something like that. Now, Jay Powell, who used to work at Carlyle, very smart person, he's not trained as an economist, and therefore he doesn't speak in Fed speak, so he can speak in English, and people can understand what he says, I think. He tells you kind of what they're going to do before they do it, and he explains why they did what they did after they did it. And so he's pretty much told everybody that you can expect a 50 basis point increase this week, and I'd be shocked if you'd get anything other than that. And I think the markets have now accepted that as evidence that the Fed is making progress on getting inflation down. So as a whole, I think the Fed is managing things as well as it could be in a situation where the Fed isn't to blame for the COVID problems we had, and COVID dealt with, it helped, in effect, produce higher inflation as well as some other things did. The biggest cause of inflation that we have in the United States now is probably the $5 trillion that we injected into the economy under President Trump and President Biden. And then the Fed also had quantitative easing, and they had interest rates at zero. That produced inflation. There are other factors as well, but those are the biggest factors. And now we're trying to make up for that inflation by increasing interest rates. And obviously it's working to some extent, but not as much as I think the Fed would like. But they're on track, I think, for where they want to be.
The UN put out a report last month, and they urged the Fed to stop raising interest rates, principally because it hurts poor countries disproportionately to rich countries. And to your point about people looking out for themselves, I don't think central banks have an obligation to look out for others, but is there either a moral or a practical reason that the Fed should take a more global view of what it's doing?
The Fed is chartered to worry about the currency and inflation. That's their main mission. In the 1970s, they were given an additional mission of worrying about unemployment. They don't have as a specific mission to worry about the strength of the dollar versus other currencies. That's not their specific mission. They do take into account, they look at it, but that's not their main goal. Their main goal is to make sure that we have inflation as low as we can get it within reason, and also that the impact on employment is not as bad as might otherwise be the case. The Fed has now said that they'd like to get inflation down to 2%, which is where it was for 25 years or so. 2% is maybe, in the view of some, too low, because to get inflation to 2%, you probably have to have your unemployment rate go up to 6%. Now, the Fed can't publicly say, well, I want unemployment to go to 6%. It doesn't sound good. So they just say we'd like inflation to be at 2%. But if you go back and look at your economics textbooks when all of you were in college, they would say that inflation historically in the United States of about 3% a year is probably normal. We had an abnormal 25-year period of time when it was lower than that, 2%. If the Fed ultimately, as I think it probably will at some point, lowers inflation or increases the inflation goal to 3%, I think they have a chance of avoiding a recession. Nobody really knows whether we're going to have a recession or not. Everybody has written a memo to their files saying we're going to have a recession. And if we have a recession, they'll pull that memo out and say, guess what? I told you we were going to have a recession, because everybody's more or less predicted. This is the most predicted recession of all time. Eventually, we'll have some recession at some point, I don't know when, and when we have it, people will say they predicted it. But the truth is, nobody really knows, including the Fed, whether their increase in interest rates, even the more modest increase, is going to put us into a recession. Historically, when you increase interest rates this much, it does produce a recession or a hard landing. But right now, the Fed is mystified a bit why the unemployment rate stays so low. Normally, if you increase interest rates, you expect unemployment rate to go up, but it hasn't done so. In fact, it stayed roughly the same. There's some explanations for that, but that's one of the challenges right now the Fed has, is unemployment's not going up, and therefore the demand is still there, and demand is not, going down as much as they thought it would.
I want to talk about investing in Africa. Carlyle has a small legacy fund. You've been in the space a long time, but I think, a third of sub-Saharan African countries have had a sovereign downgrade in the last couple of years, still a ton of political risk. How do you think about that, especially thinking about how emerging markets have done in the last 10 years?
So the theory of emerging market investments is that there is a younger population, higher growth, less competition, lower prices. And that was what led people to come to the greatest emerging market of all time, which was the United States. When people came here initially, we were seen as an emerging market. Now, the phrase emerging market hadn't been invented yet. They were called other things. But when essentially we were an emerging market, and we emerged, as emerging markets sometimes do. In the last 25 years or so, as the phrase emerging market took hold, there was a general consensus that if you invested in the emerging markets, you probably would get a higher rate of return with bigger risk, but higher rate of return than you would in the developed markets. And so a lot of money poured into the emerging markets, Latin America, Africa, the Middle East, Southeast Asia, and the results did not turn out to be quite what people expected. The rates of return were not higher. They were probably in cases lower, and the risk was higher. So when we had our own problems in the United States with COVID and things like that, people began to say, well, the risk-reward ratio in many emerging markets is not worth putting that much money into it. So money has pulled back, and the currency has also been a big factor, because the money that was invested in the height of the emerging market phenomenon hasn't done that well for investors, because if they were dollar-based investors, the currency in which the dollars were invested has not kept up with the dollar's value. So the money that you might make a successful investment, but in the currency may not against dollars be that successful. On the other hand, the best time to invest in any place is when people tell you not to invest there. I did a book recently on investing, and I interviewed the best investors in the United States. And the most common thing that they have together is that they go against the conventional wisdom. If you just go along with the conventional wisdom, you will be, you might as well buy an index fund. So what you really do want to do is find opportunities where everybody says don't do that, and then with some appropriate caution, do it. And right now, the most common mistake investors are making generally in the United States and around the world is as the markets go down, public markets go down, they're pulling their money out. Of course, when markets were going this way in the tech world, people put their money in. Obviously, you should probably do the opposite. The markets are going down, so you're probably going to buy things at lower prices. They could go down another 5 or 10%. You never can time the bottom of the market or the top of the market exquisitely well. But now that the markets are saying emerging markets are difficult, Africa is difficult, it's probably the best time to go in because things are much cheaper. And you can buy things at modest prices compared to what you can buy them in the United States. So I would say I am investing in Africa again. And I personally believe that the prices will be low enough and the opportunities are still attractive enough, and there's less competition than there was even 5 years ago.
You talked about competition. If the U.S. isn't going to invest largely in Africa, the Chinese certainly are. And I'm curious what you make of sort of the continent as a sphere of sort of soft power as this decade plays itself out.
Yeah, I think some of the money going in from China is probably not driven by internal rates of return. And so they're probably focused on other factors. The money that goes in from the United States is probably more driven by internal rates of return. On the other hand, there's a lot of organizations based in the United States would invest global money, IMF and World Bank related kinds of organizations that are trying to help emerging markets, and they are willing to take somewhat lower rates of return than maybe a traditional investor. But if you think about emerging markets, remember the phrase emerging markets is relatively relatively new one. It's about 30 years old or so. Whatever you want to call these markets, they're markets which are not as easy to find investments, not as easy to find good professionals to run the companies, not as easy to find exit opportunities, but that's the challenge of investing. And if you're going to be an investor, you've got to take some risks. And this is probably now a pretty good risk-reward ratio because prices are lower. There's less competition. You probably can negotiate the deal you want much more readily now in Africa or other parts of the emerging market world than you could 5 years ago.
We'll talk about coming out of the pandemic. For a lot of reasons, Western companies are trying to diversify their supply chains, be more resilient, much less reliant on China, both for economic reasons and political reasons. How dramatic do you expect that to be? And then who are the global winners and losers in that? Where does that activity go?
The activity of supply?
Yeah, like if you're a Western company, you're trying to say, I want to get less of my stuff from China. Where does that go?
Well, when we had COVID in this country, we finally realized how dependent we were on the supply chain for medical supplies of China and other countries, say in Asia. So there was a big push, and there is a big push to not be so dependent on third-party countries for vital supply chain things. So some companies have now begun to move their supply chains closer to the United States and maybe not so focused on China. There's a cost to that. I mean, the reason that people had these supply chains that were dependent on, let's say, China or other things, is it was the lowest cost provider, and therefore you had inflation lower. So when you change your supply chain, almost by definition, you're probably going to have a higher cost of buying products or services, and therefore more inflation. That's a trade-off that I think the United States is willing to make in certain areas, certainly healthcare. Clearly, semiconductors is another area we're willing to make that trade-off. But you have to recognize it's hard to reduce inflation when you're bringing supply chains back into the United States at higher costs. So there is a trade-off there. But I do think the United States is interested in doing this, and companies are interested in doing this, because nobody wants to be hauled in front of a congressional committee and saying, why are you getting all your products from China or something like that? So I think every company is trying to do more than they did before to change their supply chain, but I don't think they're going to make it completely the case where they don't get some things from China, but it's going to be much different than it was in the last 20 years or so.
Where does that go? Southeast Asia, Latin America, Africa, Europe?
Well, some will come back to the United States. Some will go to other places in Southeast Asia that don't have as much political risk. So Vietnam, Korea, some Japan, some modest amount in Singapore, Malaysia, some other places, and India as well. So more and more things will get produced there. If they had been the lowest cost provider for the highest quality services, it probably would have gone there before. But this will take some time, and I think China recognizes this is a big challenge. I think Apple announced the other day that they would like to begin to make their iPhone essentially from parts not produced at all in China.
Yeah. Time for one more, I think. There's an argument that we've seen peak China, that the Communist Party doesn't quite have the control over the economy that everyone assumed that they did. I think sometime next year, India's population is going to surpass China. They're democratic, English-speaking, educated. What do you make of, I think a lot of the narrative of the next decade is it's the U.S. and China. Is that a fundamentally flawed way to look at the world?
The U.S.-China relationship is not very good. I think when President Nixon went there in '72, people didn't really know what to expect. When I was in the White House, President Carter ultimately in the late '70s officially recognized China, and we've had an incredibly closer relationship with China than might have been predicted in the early '70s. But now it's probably a little bit off track. President Biden and President Xi met recently, but that was just one meeting. It'll take a while to get it back on track. And we have challenges with China that are not just economic. There are geopolitical challenges and I would say military challenges that other countries don't have. So we are unique. If you go to Europe, they don't have the same challenges and they don't have the same fears of China as we do, because we see them more as a geopolitical rival and a military rival as much as an economic rival. And right now, there's also a technology rival. All of us want to control the technology of the 21st century, and that's a big challenge because in the end, in most parts of the world, you're either going to have an American technology or you're going to have a Chinese technology, and we don't know yet which one will prevail, but clearly we think it's better in this country if the American technology would prevail.
That's all the time we have. Thank you so much
All right, thank you
for joining us.
My pleasure.